Have you ever wondered how traders manage to beat the S&P 500 even during a choppy week? In today's video, we're diving deep into a live trading session where crypto and gold strategies not only survived market volatility, but actually outperformed one of the world's strongest indices. You'll see the real trades, the setups behind them, and how a disciplined approach made all the difference. We'll walk through the thought process, the technicals, and the outcomes. Stay locked in because by the end, you'll have a clear blueprint for leveling up your own trading game. Let's jump straight into it. Quick market recap. What happened this week? Markets this week were a roller coaster, with crypto showing surprising resilience and gold benefiting from global uncertainty. Bitcoin saw sharp swings around key technical levels, while Ethereum moved sideways with bursts of volatility. Gold, meanwhile, caught a safe haven bid as investors worried about economic slowdowns and central bank moves. The S&P 500 struggled to maintain momentum after strong early week gains faded under mixed earnings reports. These crosswinds created pockets of opportunity, but only for those who were ready and adaptable. Recognizing these dynamics early set the foundation for the trading decisions we'll break down next, making strategy the real MVP. The trading strategy in focus, core principles. The core strategy used during this session focused on trend following with strict momentum confirmation. It's a hybrid approach blending technical analysis with disciplined risk management, allowing trades to align with prevailing market sentiment. Instead of predicting tops or bottoms, the strategy waits for clear breakouts or breakdowns backed by volume. Key indicators like moving averages and momentum oscillators provided the green lights. Patience was critical. Trades weren't forced but carefully selected. This simple yet powerful system kept trades aligned with the path of least resistance, which was crucial given the week's choppy and unpredictable environment across crypto and gold markets. Crypto trades breakdown. Entries, exits, and risk management. Crypto trading success this week hinged on clean setups and tight execution. Bitcoin offered a breakout opportunity above a key resistance level, confirmed by strong volume and RSI strength. Entry was taken on a clean 4-hour candle close, with a modest stop loss just below recent consolidation lows. Profits were scaled out strategically as the move extended, locking in gains and reducing risk. Ethereum presented a false breakout trap, reminding us why stop placement and risk caps matter. By staying patient, honoring stop losses, and letting winners run, the crypto trades delivered strong returns while minimizing exposure to sudden reversals. Gold trading moves, how and why they paid off. Gold trades this week were a textbook example of playing defense while still seeking profits. As global risk sentiment worsened, gold formed a bullish flag on the daily chart, a classic continuation pattern. Entry was triggered on the breakout above consolidation with confirmation from rising MACD momentum. Stops were placed conservatively below the pattern's base to avoid shakeouts. Gold's smooth climb allowed for gradual profit-taking at key Fibonacci extension levels. The trade worked because it respected the broader narrative. Uncertainty favors safe haven assets. By aligning technical setups with macro trends, the gold positions delivered steady, reliable gains throughout the week. Key technical indicators that drove decisions. Technical indicators weren't just background noise, they were essential tools that shaped every decision. Moving averages like the 50 EMA serve as dynamic support and resistance guides, helping define trade entries and exits. The Relative Strength Index, RSI, provided momentum confirmation, especially on breakouts where volume spikes lined up with overbought expansions. Fibonacci retracement levels helped identify pullback zones where risk-to-reward ratios were favorable. These indicators weren't used in isolation. They were layered together to form a full picture of market conditions. This structured approach minimized emotional trading and maximized the probability of catching high-conviction moves. Timing matters. When we entered and exited the trades, perfect timing wasn't about guessing. It was about reacting intelligently to the market's cues. Entries were executed only after confirmation, not anticipation, which reduced the chances of getting caught in fakeouts. Patience paid off in gold, where waiting for a proper breakout saved us from a premature entry that would have been stopped out. Exits were equally strategic, with partial profits taken at predetermined resistance zones and final exits. Lessons learned: what worked and what to adjust. This week reinforced the power of sticking to a proven strategy and adapting only when truly necessary. Following momentum, honoring stop losses, and scaling profits led to outsized results. One area for improvement was reducing exposure during midweek noise, where markets lacked clear direction and false signals were more common. Incorporating additional macro news filters could enhance selectivity. Risk vs reward: why the strategy beat the S&P. The reason this strategy outperformed the S&P 500 this week came down to asymmetric risk management. While the index moved sluggishly, selectively targeting volatile assets like crypto and gold allowed for outsized returns without reckless exposure. Every trade was structured with a risk-reward ratio favoring 2 to 1 or better, meaning wins significantly outweighed the few losses. Position sizing was kept tight, so even inevitable small losses didn't dent the account. This disciplined approach let the portfolio compound while the broader market treaded water. In short, it wasn't about being perfect. It was about being consistently smarter with every single trade. How you can apply this strategy going forward. Applying this strategy yourself starts with building a strong framework. Use confirmation-based entries, respect risk, and be ruthless about exit plans. Focus on assets with clear momentum, whether it's crypto during a breakout or gold responding to macro news. Keep your setups simple and repeatable. Complex strategies often fail under pressure. Most importantly, stay patient and wait for the market to come to you. The opportunities are always there for those who are prepared. Don't chase, don't hope, react based on evidence. This mindset shift alone can put you miles ahead of most traders struggling to stay consistent. What's next? Market outlook for crypto, gold, and stocks. Looking ahead, crypto markets are showing signs of consolidation before the next major move, with Bitcoin holding key support levels. Gold remains well-positioned if economic uncertainty continues to mount, offering safe haven flows. The S&P 500 faces a mixed bag with earnings season volatility and lingering recession fears. Smart trading will mean staying nimble, watching macro headlines, and letting technicals lead decisions. Eyes are particularly on upcoming central bank meetings and inflation prints, which could set major trend shifts. Keep your watch lists tight, your entries clean, and stay focused. The next few weeks could be full of opportunity. This live trading session showed how discipline, timing, and a simple strategy can deliver results that beat even the S&P 500. Whether you're trading crypto, gold, or traditional markets, success comes from preparation and execution, not luck. Thanks for joining us here at Nexus Dividends. If you found this breakdown helpful, smash that like button. Share your thoughts in the comments, and make sure to subscribe for more sharp, real-world trading insights. Stay sharp, stay strategic, and get ready for even bigger wins ahead. We'll catch you in the next one.